Hello everyone! Today, as promised, we'll be talking about the largest company on the US stock market and in the world overall. NVIDIA, a company with a market capitalization of almost $4.5 trillion. Take a look at the chart. These are monthly candles. I've prepared something for you. Let's start with this. If you had bought $100 worth of this company's shares in October 2002 and sold them in October 2025, you would have ended up with $350,000. It's enough to say that the S&P 500 index grew only eightfold over the same period. In other words, $100 would have turned into $800. But out of thousands of companies, picking the one that went from 6 cents to $212 is extremely difficult. So there's no need to be upset about it. Instead, we'll do a technical analysis. We'll start with the waves of decline. The first wave of decline happened during the dot-com crisis, when the stock fell from 60 cents almost tenfold down to 6 cents. The second wave of decline was connected to the mortgage crisis. The crisis in the real estate market brought down the entire stock market. At that time, the stock lost 86% of its value. The next crash happened in 2018 and was directly related to the collapse of the cryptocurrency market. A huge number of people were mining Ethereum using graphics cards, and NVIDIA was left with massive stocks of unsold GPUs after the cryptocurrency market crashed and mining became less attractive. The next crisis occurred in 2022 and was caused by a combination of macroeconomic factors. First and foremost, it was the increase in the Federal Reserve's key interest rate. Money and loans became very expensive. As a result, the stock dropped by 69%. And starting from 2022, there was an extreme surge in growth, coinciding with the development of generative artificial intelligence, because NVIDIA's chips fit perfectly into this technological breakthrough. Now let's take a look at the technical analysis. Notice that in this section, the two red lines represent a divergence. This monthly scale divergence caused only a minor correction and then an even stronger growth. It might seem that it didn't play out as expected. But note that the mortgage crisis did play out this divergence and then some. In other words, we fell significantly below the point where this divergence began to form. The next section with red lines is another divergence. And again, the growth continued and formed the next divergence, this time marked with yellow lines. And what happened next? A drop, along with the decline of the cryptocurrency market, and it reached the point where we started measuring our divergence. Interesting, isn't it? Look, the next divergence is marked with yellow lines. The price is rising, but the RSI indicator's highs remain unchanged. And again, the drop came roughly to the point where this divergence started to form. And finally, right now, there's a clearly pronounced divergence. The RSI highs are decreasing while the stock price highs are rising, and this means that with high probability, the stock will drop at least to the point where the divergence began. That's $140 per share. Besides all that, let's remove all the markings and just look at the chart. What do we see here? What we see is that in November, the stock experienced a bearish engulfing pattern on the monthly scale. You will hardly find any candle where a monthly engulfing occurred and it wasn't followed by a new low and, as a rule, a much deeper decline. And this means that the stock is very likely to fall below its current levels and below the November low. And that's $169.55. And with a fairly high probability, it will reach the 50-month moving average, where it has been more than once before. Take note, it approached here, and now, against the backdrop of divergence, it might go there once again. This is the area of $80, maybe $85, where the low of April 25th passes right here. I want to draw your attention to two metrics for this company. The PE ratio, that is, the coefficient that shows the ratio of the stock price to earnings per share, 43.1. This is an extremely high value. This means that investors are paying for aggressive future growth of the company, which may not even happen. You have to understand, when you have $100, turning it into $200 probably isn't that hard. But when you have $100 billion, turning it into $200 billion is much more difficult. Because large sums and big projects are harder to scale in terms of percentage growth. So it's reasonable to expect growth from the company, but rapid and aggressive growth is a big question mark, especially against the backdrop of a bear takeover and a monthly scale divergence. Another ratio is the price-to-book ratio. This is a ratio that shows the relationship between the company's market value, its capitalization, and its book value, when it is 35.5, even 35.6. This indicates that the company is highly overvalued. Why? Because normally this ratio is 1 or 2. Well, for the most successful, fast-growing companies, normally, let me emphasize, it's 5 or 10, but here it's 35. In other words, people are pricing in things for the company that it most likely won't be able to deliver, and a market correction is very likely to happen. And anyone buying now is taking on very significant risks. Don't do that. Don't follow the crowd. Have patience and buy during the correction. Where could it go? Let's look at my indicators. These are 8 time frames that I usually use for analysis with my indicators. They are 5 minutes, 15 minutes, 1 hour, 4 hours, 12 hours, 1 day, 1 week, and 1 month. Pay attention to the lower indicator. The red line at the bottom of each chart is the overbought, oversold indicator. If it is pointing down, there is a high probability that the price will go down. If it is pointing up, it will go up. Notice that on the daily 12-hour and 4-hour candles, it is pointing up, and this contradicts the decline that I am expecting. But in fact, everything is fine because I am expecting the decline on the monthly candles. On the daily candles, there is a growth target around $190. The same on the 12-hour candles and a bit lower, around $183 to $185 on the 4-hour candles. At the same time, on the monthly candles, a whole group of indicators is signaling a possible decline. And we have a divergence with the lower indicator, meaning its highs are decreasing while the stock price highs are rising. This pink zone here, which I've highlighted around $33, is the mathematical target for a decline. This is my indicator, which suggests that with a fairly high probability the stock could reach these levels. $33, just think about it, that's a drop of almost 6 times. On the weekly candles, this zone is at $152, with a potential target of $140. Right now, it is absolutely not the time to invest in NVIDIA stock. Now let's take a look at the daily candles. We can see that today's candle has engulfed several days of decline, which means that technically the price is looking upward, at least toward the 5-day moving average, which is $185. At the same time, overall, we have a sideways trend, and from this sideways movement, a decline could occur at least to the area of these previous highs, which is around $150. Let's look at the weekly candles. On the weekly candles, the price dropped to the 200-week moving average in October 2022. In April of this year, it dropped to the 100-week moving average, which means the next target could be the 200-week moving average, and that's around $80. So what conclusion can we draw? Buying NVIDIA stock right now is extremely unwise. It is on the verge of a serious correction to the level of $150, possibly $80, or maybe even $30 or $40. When should you buy? When you see a bullish engulfing pattern of monthly scale in that price range. Not a bearish one, which is what we see now, but a bullish one. And ideally, this engulfing pattern should occur against the backdrop of a bullish divergence. But right now, we have a bearish one. If you find this kind of analysis interesting, please subscribe to the channel. Tomorrow, we will analyze the Ripple cryptocurrency chart and draw the appropriate conclusions. Goodbye.